right, today is a day that has been like some others. And what I'm talking about specifically is right here. You see this day range thing that says $4,393.68 for the S&P 500. It's weird that this is the same number right there for the year range. So we're at a 52-week high, and this has become a regular occurrence. We keep hitting the highs. I keep getting notifications on my phone. And are we about to see a bubble? Now, I am largely into stocks as my overall portfolio. Have around, say, 600,000 in equity in my home. Have a few $100,000 in cash into this account. I guess I have some more cash lying around that I could scramble together. But man, we are getting to maybe bubble territory. What we're going to talk about are what I'm doing with my investing, what I'm thinking the future might hold, what you might want to be thinking about for your own investing future. We have crazy valuations. We have kind of this frothy excitement about everything opening up and everyone getting stimulus and boom of summer. So that's kind of scary to me. And we're going to discover if we're in a bubble. We're going to look through someone that's way smarter than me that has defined economic cycles, Ray Dalio, and his idea of if we're in a bubble based on certain metrics. And we're also going to talk about someone who says we are in a bubble with the Big Short famous dude, Michael Burry, who has been tweeting, markets have been now bubbling over in a dangerous way. People said I didn't warn last time. I did, but no one listened. So I'm going to warn this time clearly, but no one is still listening. He keeps tweeting these things over and over and over. Tesla souffle, because the Tesla stock is so high. Some of you guys know I have my biggest single holding in Tesla. And what we're going to kind of talk about here is if this is a bubble with everything. The everything bubble, is it finally here? Are we going to NFTs, Pokemon cards, Bitcoin, crypto, stocks? Is everything going to just explode or implode rather, and we're going to see a massive crash? So let's break this down with actual data. Now, the first thing I want you to know is that it always sounds like these guys are super smart and they're geniuses. And look, he called the real estate crash, and therefore he has a lot of credibility, right? When we look at this and be like, wow, he caused this this kind of whole wave of the Big Short movie, and he successfully called the 2007 crash. Is he going to call it again? And here's the thing with any sort of analyst. They may seem really, really smart when they are right, but it's unlikely for them to be consistently right? That's the reason why active managers do not outperform the market, right? Very small, very few percent are able to consistently do that. And Warren Buffett said maybe he's met a few people that can actively predict where the market is going in the short term. The longer term is much easier because we can see overall trends, but in the short term, it's very hard to be like, oh, sell because we're in a bubble. So let's break this down. Now, from the book Money, Master the Game, which I guess you can download it for free. I just Googled this. If you Google this exact line, then you'll probably find the free book written by Tony Robbins, who's interviewed the biggest people in the financial industry. And when he interviewed Ray Dalio, who's known for being kind of this godfather of understanding the economic cycles that we go through, and Tony asked him, hey, let's talk about the analysts that beat the market. As for the 4% that do beat the market, they aren't the same 4% the next time around. So only 4% of people, analysts, might beat the market, but they're not the same 4% the next time. So the 4% of people that accurately maybe predict a crash, it's not the same 4% the next time. And Ray Dalio put it like this. Tony, if you pack 1,024 gorillas into a gymnasium and you teach them each to flip a coin, one of them will flip heads 10 times in a row. Most would call that luck, but in the fund business, we call him a genius. What are the odds of the same gorilla after the next 10 flips? So that is something to kind of keep in mind. It's like this same people that beat the market or successfully predict something don't necessarily do it the next time. In fact, they usually don't. So let's break down if we're actually in a bubble. And we're going to use Ray Dalio's principles for comparing the past bubbles to the current one. Before I break this down, I wanted to let you know we are approaching 1,000 subscribers. Subscribe, I would really appreciate it. What we're going to be doing is extra perks for the lifetime of this channel for those first 1,000 subscribers that get in as the first 1,000. So make sure to, if you're interested in building your wealth and want to learn the principles that have helped me build my multi-million dollars in wealth, subscribe, click like on this video, and you're going to get locked in for extra perks for the lifetime of this channel as being the first 1,000. So subscribe now and let's get to it. All right, so here is an outline comparing previous bubbles to the current one. And there are these 6 different metrics. And the first one here is, are prices high relative to traditional measures? So there's all sorts of indexes and things to kind of measure if things are high, PE ratios are high, things like that. And so if we look at the differences here, the Roaring 20s was in bubble territory. Today's market is somewhat frothy. So frothy would be pretty high, right below the bubble territory. Frothy is like everything's foaming up, but we're somewhat frothy right here. Prices are high relative to traditional measures. We have inflation data coming out. We've got a lot of stuff. We are frothy here. All right, so next, prices are discounting unsustainable conditions. So are we in a place where we are kind of just discounting an unsustainable thing, right? We are just going for something that there's no way it can kind of continue. And according to Dalio, it says, you know what? No bubble right here in today's market. The next is something interesting, have new buyers entered the market. So this kind of creates more demand, right? More demand for a stock. If new buyers enter the market, prices might go up and artificially go up, especially since they're new, right? They might not know what they're doing super well. And we're definitely frothy here. We can blame this maybe on Robinhood. We can blame this maybe on crypto, attracting a younger generation. So that is definitely up there. Number 4 is there a broad bullish sentiment? So what this means is like, are people just overall positive? Now, you might think that's a good thing. It's not, right? The more positive people are, the more baked that is into the stock. So already people have bought because they're already positive. I love when there's fear in the market, because what that does, if people are like, hey, there's a crash coming, guess what? Those people have already sold. They've already pushed down the market, so there's already support level for it. The fear is when there's broad bullish sentiment. You want me to give you an example? Okay, the real estate market has no chance of going down. This was a widely believed idea, and in 2007, man, we saw something that no one expected. So right now we're in a frothy area. People are bullish. There's not a lot of fear, which is crazy, especially in my opinion with everything that's going on. 5 is purchases are being financed by high leverage. Leverage and debt cycles are a cause of these crashes, because what happens is we leverage out things. That's actually what happened with real estate, right? So that is a danger. In 2007, we saw that with real estate, and how junk bonds were kind of passed and multiplied, and the way someone could just leverage their position. And today's market, we are somewhat frothy, right? We see some over leverage in the markets for sure. Number 6 kind of relates to number 5, where we've made extended forward purchases. So this is kind of like leverage, but this specifically is like, for example, if you are buying a lot, like say the chip shortage that's going on right now, right? So in the automotive business, there's a lot of companies hoarding chips or making purchases for tons because they saw that there was this shortage. So they are just buying, and that's not sustainable, right? So anything that's kind of not sustainable ends up bubbling up. So we're kind of in a no bubble area with that. But here's the thing. All of these items here depend on the individual markets within them. This is like an average for the total market. But if we look at specifically emerging tech, we're seeing something different, right? We're seeing a lot of froth. Are prices high? Absolutely. Frothy, right? You have SPACs, you've got EV companies that aren't doing nothing. So frothy, our prices are discounting unsustainable conditions. Yes, frothy. New buyers have entered the market. Absolutely. There's so much excitement about this stuff, maybe EVs specifically, and just new technologies though. Broad bullish sentiment, absolutely. Purchases are being financed by high leverage. Yep, people are going in. And businesses have made extended purchases, right? So we've talked about that a little bit with specifically like a supply. So this is a fear with tech. And this specifically says emerging tech. So when we look at safer tech plays, like if we look at my portfolio here, all right, so right here we have Tesla and Apple. Let me give you an idea of what analysts think is safer. I'm pretty sure you can guess it, but let me show you how different they believe these things are. So we've got Tesla top, Apple the bottom. If we scroll over here, right here's the ratings. Tesla, F. Apple, A. Very different, although they're tech, very different worlds, super high profits with Apple, obviously, super kind of extrapolated profits with the price of Tesla. So very, very different. High value tech companies are different than maybe emerging tech. Tesla, to me, isn't as speculative as it used to be, especially not close to as speculative as any of the EV companies that haven't even sold a car yet. So definitely want to kind of pick and choose the companies there if you believe there is a bubble. So what am I doing? Well, what I'm doing is I am still going to buy stocks. All right, so I believe that yes, we are at an all-time high, and yes, I believe we could see a downturn, and yes, I believe specifically in those high-flying tech companies that don't have any profits or are even in production. I mean, Jesus. So those, could see a massive downturn. So what I'm doing is I'm just going in and buying my index funds. So I go in and I'm going to buy VOO or VTI and consistently do that every week, dollar cost averaging in. That's what my strategy is now. If we see a major pullback in my high conviction companies that I believe in, specifically Tesla, Apple, Amazon, or there's a few others that I've been researching more of and will make videos on, I will dive in. But right now, with how high valuations are, I probably will just be dollar cost averaging in, because the thing with investing at all-time highs is that data actually shows that it could do better than investing when things have dropped a lot. So when you can look it up, if you were to invest all the time at every all-time high compared to every time there was a certain percentage drop, it's still smart to be invested in the market and not wait for drops. I also want to make something clear with you guys. I have a long time horizon. So when I'm showing you millions in the market, I want you to understand that I'm not planning on pulling these out for 10 years plus. I'm young. I'll give you a little hint, between 25 and 35, and I am not planning on pulling this out for years and years and years. So make sure you have that scale in mind. Also, make sure you have the scale of my actual value of my portfolio, because I was talking about in my last video how, I might dump 50K here or 100K here. That seems like a lot, and I might dump that into maybe more higher risk, higher growth companies. But remember, 100K for me is 3% of my portfolio. So when I'm saying I'm investing 100K in this, instead you should think, okay, he's investing 3%. So when you're looking at your own portfolio, you can make a similar scale type consideration. Thanks so much for watching. Please subscribe. I will make sure to reply back to any comments below. And yeah, the first 1,000 subscribers, guys, you guys are going to be my OGs. So I'll talk to you soon. We'll do some cool perks once we hit that 1,000, and I'll talk to you soon. See you later, everyone.